Hello, everyone. Today on the Final Bar, we'll talk to my guest, Mish Schneider from MarketGauge. We'll try to debrief in a short period of time on Fed Day. Happy Fed Day, happy Wednesday, as we digest the market leading up to the Fed announcement, the meeting minutes, the press conference afterwards. Certainly stocks finishing in a position of strength, which is a bit of a change from recent days where we're finishing weaker. Today, the S&P closing back above 4,700. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using charts, using the power of the StockCharts platform to better understand market dynamics, and particularly on a day like today. I'm often asked on a big earnings day, a big macro announcement, a Fed day, do charts really matter? Because this is more of a macro sort of thing. And I would argue these are the days when charts matter arguably the most, because what the charts will tell you is what the market is pricing in, what anticipation looks like before the moment, after the moment, how the market is digesting, how investors are reacting, excitement, euphoria, desperation, fear, all of those things are manifested in stock prices, as John Murphy taught me early on as I picked up his book on technical analysis for the first time, and conversations with many others. I would argue days like this it's vital to be paying attention to the charts and understand how the market translates the event into investor behavior, right? Where investors are voting with their capital. And you certainly saw the markets moving higher. I've always, I've often thought, particularly this year, put a little bit of weight into how the market reacts immediately after, put a lot of weight into how the market digests that over subsequent sessions. You had a nice big strength move out of the announcement today. S&P closing back above 4,700. Does it have staying power? Because it's been unable to do so a number of times in the last 6 weeks. We'll try to make sense of that with my guest today, Mish Schneider. We have other great guests on this show often, which we're very thankful for. Tomorrow on the 16th, we have Sam Stovall, the Chief Strategist at CFRA Research in New York. Also tomorrow, I'll be moderating our latest episode of The Pitch. That is a stock picking showdown. 3 guest experts, each providing 5 ideas, stock and ETF picks. I have Aaron Swenlin from Decision Point, Larry Tentarelli from Blue Chip Daily, and TG Watkins from Simpler Trading. All will provide 5 charts each. We'll discuss and debate them as a group. You will leave with a piece of paper filled with ideas of names and tickers to look into a little bit further. Also, the next couple weeks, we do our year-end review on StockCharts TV. A lot of different programming. This show, The Final Bar, will take 2 weeks off of our live program, and we'll have a lot of really cool content to share with you instead. Next week, we'll be doing a recap of the events of the year. I'll be focusing on 5 top charts that I think tell the story of the year and where you should be focused. The week after that, we'll do a special series on the year-end routine, how to review and critique your own performance during the year. Also, starting this Monday, the 20th, through the next 2 weeks, we have the top 10 influential market events. We have 10 different guest commentators, each sharing one particular event that was meaningful to them through a technical perspective. It is a fantastic piece of content, a series of content. I encourage you to check out all of that year-end special stuff in the next couple weeks. Also, the end of the year in December, we have our holiday special at StockCharts.com. If you go to StockCharts.com/special, you can see the information. You get basically free months if you sign up for either a new StockCharts membership, or if you renew, extend your existing membership. If you've never been a premium member at StockCharts.com, there are a lot of really cool capabilities. Really, the real power of the platform. You're able to take advantage of that as a premium member. Go to StockCharts.com/special for all the information on that special holiday event going between now and year end. Let's continue on today's show with our market recap. So today's Fed Day. A little later, we're going to do a segment toward the end of the show called "Don't Fight the Fed." We'll focus particularly on the Fed meeting and some of the implications going into the next year. Just to talk about some of the market movements, during the day today, the S&P certainly finishing in a position of strength, technology and healthcare driving things higher at the end of the day. So sort of a growthy feel to the top of that. But the third and fourth top sectors, utilities and real estate. So it wasn't all offense over defense. There's some sort of relatively defensive stuff, more income oriented things, more low volatility plays at the top of the list on the trading today. But at the end of the day, the S&P finishing stronger, about 1.6%, closing back above 4,700, which it has not been able to do very often. The question I would ask, as we've talked about this range from 4,550 to 4,700, does this have enough upside momentum to propel us above 4,700 and to stay there? I mentioned on a webcast I did yesterday, I asked all the attendees whether they thought we would finish the year above 4,700 or below 4,700. It was literally almost 50-50. I think it was 54% saying above and 46% saying below. That's pretty much an even idea between those two. And I think that's about how the market feels right now. It's uncertain and it's relatively choppy. The NASDAQ stronger, with the NASDAQ 100 up 2.3%, mid caps and small caps doing just fine, but underperforming the large cap index. The VIX back below 20, just around 19. Other asset classes, very quickly, we have bond markets rolling over today, interest rates coming higher. Obviously, a lot of discussion from the Fed about the potential for rate hikes in the next couple of years. We'll get to that a little later, but 10-year yields finishing the day just above 146. The dollar index really flat, down just a bit, but nothing too crazy. Commodities as a whole broadly higher today. Now, gold was finishing lower through the course of the day, but reverted back to the upside in the 2 hours after the Fed meetings released. 2 p.m. The minutes released 2 p.m. Eastern. So gold, the GLD finishing up 0.4%, silver 0.5%, commodities using the DBC up about 0.5% as well. Cryptocurrencies bouncing higher, and you can see this is showing these trade 24 hours, and so you can see this 24-hour period with the distribution going into the morning session and then rolling up and really accelerating to the upside, with Bitcoin getting back above 49,000, Ethereum getting back above 4,000, and remaining below 4,000 had been, I think, one of the concerning patterns on the chart of Ether. Both of those starting to rotate higher, not up a ton. And again, these are relatively low days, low percentage moves for cryptocurrencies. Pretty severe for equities, but with a lot of these coins that tend to have a lot more movement. A little lesser, but overall certainly finishing in a position of strength. So it was sort of very much a risk-on feel in terms of the overall direction of the markets going into the equity market close. Here's a chart of the S&P, and of course, one day at times can make a huge difference in just the character of the chart. And I think you sort of saw that today. We've talked about this range. The brown shaded area is around 4,700. The pink shaded area around 4,550. And we've seen how this market has essentially been range bound for the last 6 months, right? When we think about the market still in an uptrend, I think that's a fair way to classify the long-term trajectory of stocks, and particularly with the S&P 500. But overall, if you look at the last 6 weeks, the high watermark was early November. From there, it's been stagnating. It's been sideways with some drawdowns and remaining within that overall range. So we bounced off 45.50, bounced off the 50-day, and now retesting the upper end of that. We pulled back earlier in this week, but today moving right back up to there. My question for the S&P, can you get above 4,700 and can you remain there? Does resistance become support? We did not break out yet today. I would argue this is trading right up to that resistance area. And so going through the remainder of this week, I think that's the main question to think of when you're looking at the large cap index. Elsewhere here, just to wrap up the market recap, as I mentioned, technology up 2.7%, and we've talked about the long-term strength in technology. Certainly, there've been a lot of movements with sectors, but if you look, these are 4 sectors that are really in strong positions: tech, healthcare, utilities, real estate, all at or near new all-time highs. They might have all made a new high today. I'll have to look at the charts to confirm that, but if not at new highs, really, really close. Given the strength that we saw today. Consumer discretionary, on the other hand, still kind of pulling back a little bit. Nice bounce today, but overall staples have been outperforming consumer discretionary in recent weeks. Only one of the 11 S&P sectors down today, and that was energy. And that's certainly a theme to pay attention to. There's been a lot of discussion on the potential upside for cyclical sectors, the potential upside for things like energy, basic materials, industrials, even something like financials, which I might group into that list of sectors. You're not seeing the strength today. It was more of a growthy move today with technology at the top of the list. Plenty of individual names showing a good amount of strength. NVIDIA comes to mind, just thinking of the overall strength. Semiconductors are a group we've talked about very often. My guest, Mish Schneider, in a little bit, might ask her about the modern family, because I believe semiconductors are one of those groups that I know she follows pretty closely to understand the overall market environment. I'm impressed with the chart of NVIDIA pulling back to the 50-day moving average, rotating higher today. That group as a whole, looking at the SMH, relatively strong, right? I mean, we've seen the strength in semiconductors for quite some time. There's a bit of a divergence within the different names, some names stronger than others, but on average, this has been a pretty strong group. NVIDIA has been pulling back. NVIDIA has been one of the strongest performers, particularly on a relative basis. If you look year to date in the group, pulling back a little bit, but today starting to bounce off a little bit. A nice move higher, 7.5%. The question, of course, is do we remain above those the 50-day? Do we continue to push higher and push the next leg to further upside? But an interesting move higher, and the whole as a whole, the semiconductor group holding up pretty well. What underperformed today? A lot of materials names. If you look at the bottom 10, and if you look at the groups that are some of the worst performers, things like gold miners, mining stocks, a lot of the group, almost half the groups in the at the bottom of the list are all in the materials sector. And then you've got some energy as well. Also some travel names peppered in here. So the hotels group is actually one of the worst performers, with Marriott one of the worst of the bunch. You know, those charts, I'm not super impressed, based on the fact that not that these charts are going down. Something like Marriott, it's not that you're losing a lot on an absolute basis. It's the relative strength that's been relatively weak, right? The problem, if you're sideways in this market, is you're not going up. And there have been a lot of charts that have been in more of a consistent cyclical uptrend. I think that's where the opportunities have certainly been. We need to take a quick commercial break. We'll be back with my guest, Mish Schneider. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close as we break down the market environment using a lot of charts. It's a pleasure to have you join us every day. A couple quick comments before we get to today's guest, Mish Schneider. First off, we welcome your questions. Feedback on your host, always valuable. Feedback on our guests, on our shows, we appreciate. But what we most like to see are questions that you are running into as you are analyzing your own charts. Email us any of your questions. thefinalbar@stockcharts.com is our email. We're on Twitter @FinalBarSCTV. We're on YouTube. Just put a comment below the video you're watching on our YouTube channel. We'll gather all those questions. We'll hope to answer one of yours live on the air on Friday's show in our next mailbag segment. Also, go to StockChartsTV.com. That is our on-demand platform. So much great content every trading day, even some days on the weekend. Great guest appearances like Mish Schneider, Sam Stovall, Mark Chaikin, Tony Dwyer, so many others. Great special events like The Pitch and our year in review coming up in the next couple of weeks. All of that on demand. Go to StockChartsTV.com or on any of your mobile devices. Just search on the App Store for StockCharts TV on demand. I want to welcome on today's guest, Mish Schneider. Mish is the host of Mish's Market Minute on StockCharts TV. Does such a fantastic job sharing investment wisdom and ideas with our StockCharts community. Mish, welcome back.
Thank you, David. It's so good to be back.
Good to see you, and I hope all of you at MarketGauge are doing well. This market, of course, as we mentioned before the show, we could spend hours talking about so many different themes. There are a lot of things happening right now. How are you making sense of this market on Fed Day with all of the volatility that we've seen? What's meaningful to you right here?
Well, just to make a very quick comment about Powell's remarks today, is a lot of that was already priced into the market. So the fact that we saw it sell off over the course of the last couple of days and then rally after his remarks were said is because people were already looking at that trimming and faster tapering. They were looking at the potential of rate hikes, which of course we know can't start until after the taper is done. So he didn't say anything all that alarming, and he kind of left himself open, of course, talking about labor market, et cetera. So it was a really interesting end of sort of a depressing week, and also auspiciously, December 15th is the day when technically the Santa rally could begin. So we're not completely out of hope. And that's why I wanted to feature the two charts that I gave you today, because it could help support our case for why hope is still alive, but also why we've been seeing these very choppy conditions, as you mentioned at the top of your show.
Start us off with small caps here. Then it's obviously an area of the market which has been struggling to keep up at times. Looking at the Russell 2000, talk us through this chart for us.
Well, going back to why we're seeing pretty choppy conditions, as you know, IWM, or the Russell 2000, is what I consider to be the granddaddy of the modern family, because it's really the granddaddy of the whole US economy. So everything that we've been seeing in terms of economic slowdown, in terms of consumer sentiment, of which you'll also see if you look at an XRT or Granny Retail chart, industrial, manufacturing, the higher cost of export, supply chain, and yada, 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 we're seeing reflected in this chart. And that's why this is actually in a distribution phase relative, say, to semiconductors, which is still in a very strong bullish phase. However, it's also been very range bound, hence the chop. So semiconductors go up and it drags up IWM, but IWM can't get past this critical resistance. So it starts turning down. And then people who are heavily long tech start taking some profit, which is why there's been very few stocks actually leading the S&P up. So we need to resolve that. So if people are sort of going, oh, yeah, what do I do here? This is the picture. The good news is that horizontal black line that you see on the chart there, underneath the July 14th low, right? That's the 207 level. So even though we've broken down in terms of phases and moving averages, we are holding that critical support. That's good. The relative leadership to the SPY, obviously in IWM, has been super weak. So really, this is a battle right here. If IWM can actually get some traction, and maybe let's say at least close the week out over 220 and hold here around this pivotal 212, 215, then whatever you're hearing from the talking heads, there's still a relative optimism going forward into 2022. And you can actually read between the lines with what Powell's saying and saying, you know what, things may not be so bad as we think. So that's kind of why I wanted to show this chart, because this is really important. And semis are always the great generals, but if their soldiers don't come behind, eventually the general has to change its course of action.
I love that way of describing that relationship, Mish. And small caps, you're finding similar issues with a lot of the breadth readings that have come off a little bit, certainly reflecting that as well. Now, I was taught early in my career to think about bonds first and stocks second, that bonds will often lead stocks, so focus there. Your second chart is looking at the high yield market, JNK. Talk us through this one.
Well, I love looking at the high yield bonds because really it's the ultimate risk on appetite, because people will buy high yield junk bonds, companies that aren't doing well but offer very high yields when they think the market's going up. And this too, of course, has now suffered some kind of a defeat, but over the longer term trend, it's still doing pretty well. And even again, even though it's come down in terms of phases, it's also holding very critical support. And if we take a look at the relationship, now this is where we have the ACP plugins. So I want to talk about the one that says leadership. So if you compare this to the benchmark of the SPY, it's actually, at least before the close today, it may have adjusted a little bit, but it rallied along with the SPY. The question is the relationship. So if junk continues to do a little bit more outperforming of the SPY, that means that there's still risk appetite there. That's probably one of the best signs I can make for the overall macro at this point. And even though the momentum had declined, the momentum on the bottom indicator, which is real motion, is now starting to tackle that blue line. That's the 50-day moving average. So if momentum comes back and we couple that with what we just talked about with Grandpa Russell, then again, the retail investors can stand up and cheer because they have been supporting this market, the buy the dip crowd, and they may turn out, at least for a while, to be right. Now, there's a flip side, which we can make, but I always like to be more cheerful than gloomy.
I'm not surprised to hear you say that, Mish, knowing you from getting to know you in recent years. Dude, we have about 30 seconds left, but I'd love to just ask about the improvement in some of the defensive areas of the market. Things like utilities and real estate, especially in the last 4 to 6 weeks, starting to emerge. Does that concern you to see an area like utilities start to do better, or how do you make sense of that relative to the overall structure?
Well, in my book, I say that when Uncle Utes shows up at the door drunk, it's time to pay attention. And so he has definitely shown up at the door drunk. And
Yes.
actually, I believe, made new all-time highs.
Mm.
So is a concern because these are defensive plays. It's also interest rate sensitive. But there's one other area in terms of utilities that is new to the picture that could mean that maybe it's not quite as inebriated as we would think. And that is, of course, the infrastructure package, because a lot of the stocks within the XLP space, within the XLU space, because Staples is another defensive play, are actually tied to infrastructure. And especially with 5G, and then of course we have water in there as well. And some of those water stocks have done well, like American Waterworks. And so it could be a reaction to that. It could be a defensive play. It could be a warning. But right now the relationship has shifted. And this is also telling us that it's not all that worried about interest rates right now, even though everybody's worried about interest rates. Drunk Uncle You is not.
Mish, it's such a pleasure to see you. Great to hear your views. Thanks so much for sharing it. Wish you guys at MarketGauge well. Happy holiday, and we'll look forward to talking to you in the new year.
Happy holidays to you and at StockCharts so much.
That's Mish Schneider. Mish is the director of education at MarketGauge, based in New Mexico. So such a great job, and she peppered in some of those. I love the caricatures she has for different parts of the market. Uncle Utes, Grandpa Russell, and others, and her book does a great job of just describing why those members of the modern family are so important to watch. She mentioned their MarketGauge premium plugin, which is part of ACP. If you go to the ACP platform, there's a little plugin icon on the right. You can see information about their plugins, Real Motion and Leadership, which are really well done to help you understand how the chart you're looking at relates to other things you could be paying attention to. Great take from Mish Schneider there. Let's continue on with our next segment, Don't Fight the Fed. So happy Fed Day, as I mentioned, and I'm so thankful that Misha actually added some comments just about the, how to think about the Fed. And, the think about the comments she made, that's kind of where I wanted to start. And I really like that starting point. If you look at what the market has done the couple days leading up to the Fed announcement, even today, earlier in the day before the announcement, you get a sense of what the impressions were leading up there. That was a bit of negativity, a bit of skepticism about what we might hear, and bracing for impact for some sort of negative indication. The fact that the markets rallied so much from here basically means that anything that was talked about in terms of multiple rate hikes likely in the next year, prospect for further rate hikes in 2023, essentially, if you can say that, priced in to the market right now. I would argue that I probably am a little more skeptical about the market's ability to maintain optimism as the Fed continues to taper. And I think that's one of the conversations I've had with guys like Matt Maley at Miller Tabak. Often reminds me when we speak about the long-term uptrend in stocks and how much Fed liquidity has been a catalyst for that, right? The market continually moving higher in a lot of ways is a liquidity-driven rally, he would argue, and others would argue, because of the support of the Fed. And now the Fed is basically saying they're going to be lightening up and taking their foot off the accelerator at some point going into next year, stepping on the brakes in terms of rate hikes and changing policy there. I don't necessarily see how the market can interpret that at the end of the day as a net positive, but you're seeing today that the market certainly can do so. Let's look very quickly at the chart of the S&P. So the Friday was the most recent time we closed above 4,700. Monday, Tuesday sessions both lower. This is really sort of a sideways down period leading into today's meeting. We opened a little bit lower, below 4,650, traded lower by the end of the day, got back above 4,700. If we look at the two-day preview chart, you can see what was happening earlier in the day. Again, this is not a huge optimistic anticipation of what was to come. This was a lot of skepticism in the last couple of days, but clearly resolving to the upside and moving higher. So it's interesting that this week you have the PPI number indicating significant inflation concerns or the possibility of extended inflation. You have Powell talking about elevated inflation. The word elevated was used and not transitory, which is a noteworthy change in how we describe what inflation is. And then again, the market moving higher going into the close today. Let's look next at interest rates. When we think about the Fed, you need to think about the interest rate environment. We'll look at it from a couple different angles. And by the way, if you missed my interview with Tony Dwyer, I think that was last week, maybe last Wednesday, if I remember right, I would certainly go back to do that. Go to stockchartstv.com to see that interview because we talked a lot about interest rates and just how to think about that. He's done a great job when he's come on the show of framing out Fed meetings and how they potentially can impact things. You know, when I was writing a note for my market misbehavior premium members this morning, just trying to set the stage for the Fed meeting, we looked at the chart of the 10-year, and what I noted was, if you look at February of 2021, the end of February, after rates had come up quite a bit, this is from 0.5% and less in mid-year in 2020 and rallying back up to nearing 150. We're right at that same level. So since March, February, we've really essentially gone nowhere. Now, we haven't gone nowhere. We've gone quite a bit, right? So we've ranged from 145 up to 175, all the way down to 115, back up to 170, and now back up after undercutting it a bit to settle right back to that same level. So it's been a choppy period, but it's not really been a directional period. If you think of this chart in three phases, you have the downtrend phase, the first third, the uptrend phase, the second third, and then essentially a sideways, very big range, but still a range-bound period that we've seen in rates. When I think about the interest rate environment and what that means, I would always remind you that the shape of the yield curve should be thought of, I would argue, in terms of headwinds and tailwinds. If you think about, all right, rates are going to go higher, and clearly that's the expectation in the coming years. Rate hikes, that's obviously the short end, but most likely you see interest rates as a whole going up in the next couple of years. You know, what does that generally mean? Well, that should be a tailwind for certain sectors and a headwind for other sectors. A tailwind for more of the value-oriented stocks, a headwind for growth-oriented stocks that struggle when interest rates are elevated. But remember, I would describe them in terms of headwinds and tailwinds, and that's how I would think of the Fed announcement today and the prospect of higher rates and how to digest those future potential rate hikes into 2022. Think of it in terms of not absolutes. Banks should do this. Growth stocks should do Y because of higher prospect of higher rates. Think of it in terms of headwinds and tailwinds, because there are a lot of different competing narratives that are going to move any particular stock, any particular group. And at the end of the day, to wrap up the segment on Don't Fight the Fed, it was a great reminder for me to ignore potential narratives a little more and focus more on the actual prices. The charts will tell you where you should be focused. The charts will tell you what's working. Charts will tell you what's not working. Don't ignore the charts on a day like this. Embrace the charts. Immerse yourself as much as you can on the visualizations of these dynamics. We need to wrap the show and go to the 3 in 3, 3 charts in 3 minutes. Here we go. Chart number one is a breadth chart we haven't looked at too often, actually, recently, a little bit. But this is the percent of stocks above their 200-day moving average, percent of stocks above their 50-day moving average. This is not quite updated for today's close yet. So this is as of Tuesday's close. Most likely will bounce up a little bit given the strength that you saw going into the close in a lot of different areas of the market. But as of yesterday, it was just around 50% of S&P members above their 50-day moving average, which means about 50% below their 50-day moving average, which I thought was really interesting. The S&P coming off of all-time highs, the S&P nearing another test of 4,700, reaching that again today, but literally it's half and half. It's 50 and 50, whether a particular random stock you pick is above or below its 50-day moving average. This plays to, I think, what Mish Schneider was saying today about the Russell 2000, looking at breadth indications that have been less supportive. It tells you that it really is a mixed market right now. Second chart is healthcare. You know, one of the sectors making new highs today, new all-time highs, the XLV, with the XLV getting just above 138 into the close. The relative strength starting to improve a little bit, which is interesting, making a new 2-month relative high. Certainly potential for further upside here. But if you look at the chart here, it's a bit of a, what I might call a pennant pattern or a symmetrical triangle where you have lower highs, higher lows. You have this consolidation pattern right around the 50-day moving average. Now with today's close higher, breaking out of that pattern, confirming a breakout to the upside, indicates further upside potential for healthcare. And I'm finding names that are improving. One of my guests recently talked about the biotech space ITB, which I think is pretty interesting. I'm showing Amgen right now, and it's worth noting, while we've seen some bearish divergences on a chart like the S&P and other names that we've highlighted recently, you actually have a bullish momentum divergence on the chart of Amgen. Lower lows, October through end of November, early December, higher lows in momentum, October through end of November, overall indicating some upside potential. Testing that swing high right now, just around 220. For StockCharts.com, I'm Dave Keller in Redmond, Washington. Thanks for joining us. We'll see you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.